Hey, what's up, guys? My name is Saadi Sabah. I'm a CPA and financial advisor, and today I'm going to be discussing what is an S corporation. I've been seeing a lot of misinformation online and through social media, so I figured I'd make a call educating everyone on what it actually is. So, this video is primarily for small business owners, freelancers, people operating an LLC. And the reason why this matters so much is because there are huge tax saving opportunities within S corporation. So I wanted to discuss what it actually is, who qualifies, how it saves you money on taxes, and the biggest mistakes to avoid that I've seen in my years of preparing taxes. So, first off, an S corporation is a tax classification. It is not an entity type. So, oftentimes I'll see the headline LLC versus S Corp. It's not a side-by-side comparison. Again, an S corporation is a tax classification by the IRS designating how a small business should be taxed. There are multiple tax classifications. There are sole proprietorships, partnerships, S corporations, and C corporations. And for the purpose of this video, we'll only be discussing S corporations. So again, it's not a legal entity, it's just a tax classification. And this election is available to LLCs and corporations. So if you're a sole proprietorship or a general partnership, you can't make this election unless you form an entity. Now, how is it taxed? What makes it so special? An S corporation is what is considered a pass-through entity. This means the business itself doesn't pay any taxes, but the individual shareholders pay tax on their share of profits. Now, they pay tax on their share of profits regardless of whether or not they take money out of the business. And it avoids that double taxation that a C Corp incurs, because a C corporation pays tax on the business's profits, and then the owners pay tax when they take distribution through dividends. So it's a double taxation. And that's why the IRS, they wanted to alleviate the burden for small businesses, and they created something called an S corporation, where the business itself doesn't pay any tax, but the taxes are paid on the individual level one time on each shareholder's personal tax return. So, what are the key requirements to qualify for an S Corp? You need to be a US based entity, have 100 shareholders or less, and each shareholder must be an individual. It can't be a trust, no foreign partnerships or owners and things of that nature. It needs to be individual shareholders. And there are some small other exceptions too, but majority of the fact is you need to be an individual. There's only one class of stock, so you can have multi-layer stock structuring. So if you're looking to raise capital, S corporation is not for you. And to make the election, you have to file a form with the IRS called Form 2553, and it needs to be filed timely. So the election is always due by March 15th of the current taxable year that you want to make the election. So for example, for 2025, if you want to be taxed as an S corp, that election or form has to be filed with the IRS by March 15th. Now, you can get election approved late. There's an extra step and requires certain procedures. So if you are looking to make the election and it's past the deadline, be sure to work with a CPA or tax professional to make sure you do it properly and get it approved on the first try. Now, how does an S corporation save you money? Uh, so when you're not, let's say you're a sole proprietorship, the biggest driver for tax savings is the limitation on self-employment tax for an S corp. So for example, let's say you're a sole proprietorship and you made $100,000, your self-employment tax owed will be $15,300. The S corp helps limit that 15.3% tax, where they only tax 15.3% on your salary, with the remaining distributions taxed at 7.65% for your FICA tax. Let me show you an example and put it on the screen. So again, an example, if you're a sole proprietorship, let's say I'm a barber shop, or I'm a barber, I'm sorry, and I made $100,000 in profit. My self-employment tax alone will be $15,300. Now, let's say I worked with a tax advisor and I changed to being taxed as an S corporation. I paid myself a reasonable salary of $40,000. And again, they want their fair share. Remember, the IRS always wants something. So they want 15.3% tax on your salary with the remaining not taxed at 15.3. And the salary has to be reasonable. So just be sure you work with the CPA when trying to figure that out. It's not always in your best interest to lower the salary as much as possible because there are other limitations that you lose out on in terms of a tax benefit with a small salary. But that's another video. Uh, so again, back to my example, if you're a sole proprietor and you made $100,000 in income as a barber, your self-employment tax owed is $15,300. Now, if you're an S-Corp and you gave yourself a salary of 40,000, you'll pay 15.3% on this 40,000, which is 6120, but that remaining 60,000 that you can distribute or contribute to your basis is taxed at 7.65% for a total of 45.90. So the total tax is paid as an S corp 10,710. Total tax as a sole prop 15.3. So the savings alone by switching to an S corporation is $4,590 simply by being taxed or making the election. And now the savings only increase as your income goes higher, right? So again, this is a real world example of how it saves you money, but there are other costs within S Corp. It's not always the best solution because you have to factor in payroll cost, extra accountant prep fees, and things of that nature. So there needs to be a cost benefit. It's one of the rules of accounting. Does the cost outweigh the benefit? Hmm. And it's something that always needs to be considered. So to become an S Corp, here's the timeline. You would form the entity, the LLC or the corporation, apply for an EIN, file Form 2553, set up your payroll and bookkeeping, and you file an annual S corporation tax return, which is due by March 15th. It's not like the individual taxpayer deadline. It's always 1 month before. So it's due by March 15th unless you file an extension. And then common mistakes to avoid: taking zero or a low salary. Now, this is a high red flag for the IRS. Exposes you to an audit much more higher than versus you taking a reasonable salary. So be sure you're not abusing this. Missing the deadline, that's another big one. This tax savings you can lose out are massive. I have people come to me during the middle of the year in the six-figure marks in terms of profits, and they're nervous that they can't get the election approved, thus resulting in paying thousands or more in taxes. So you always want to plan ahead of the game. And again, if it is late, be sure to work with the CPA or tax advisor. They'll be sure to get the election approved the first time. You don't want to play around with this, especially when we're talking thousands, if not more, in dollars. And another big mistake is mixing personal and business funds. You want to operate as a business, make sure you have a separate business account and you're not running any personal transactions through the business. It's not a good look, especially in terms of the IRS. They could disallow a lot of things if they consider that this is not a legitimate business and you're not operating for profit. And one of the things they look at is if the owner is taking personal transactions through the business. The best way to pay yourself is through a distribution or payroll. Is an S corp right for you? Again, you want to weigh the potential cost benefit, right? Does it make sense to spend $2,000 to save $500? So if the savings are there, we make the election. If it's not there, don't make the election. And always remember, every state and locality has their own rules and nuances. So it almost never makes sense to become an S corp, for example, in New York City. Again, because New York City has its own tax laws and rules, and they don't even recognize S corps. So just be sure you're working with a tax professional. You don't form an S corp right away because there are different state regulations and, if applicable, local regulations as well. And this is not ideal for real estate owners, passive income, or low profit businesses. So do not make an S corp election if you're in the real estate game unless you work with a CPA. If your business has low profits, because again, the cost benefit isn't there, or for a passive income structure, it doesn't make sense as well. And some tips as a CPA and financial advisor, you want to use a real payroll system because once you have an S corp and you take a payroll salary, it opens up a whole can of worms in terms of workman's comp insurance, unemployment insurance, things of that nature, where you're going to want to have a professional payroll setup where they handle all those filings because it could get very messy very quick. You also want to reassess your salary every year because you giving yourself a small salary not only raises the potential for an audit, it also limits your other benefits and deductions. For example, taking a small salary could have a severe limitation on your QBID deduction. I will go over that in another video. Uh, and being late in filing the election late unless you have a reasonable cause statement. So again, be sure you work with a CPA or a tax professional that has experience getting a late S-Corp election approved. You never want to play around with these things, especially when it's in the thousands of dollars. So just to recap, an S corporation has potential to save you thousands in taxes. Be sure to consult a CPA before making the decision and subscribe for more tax saving tips and videos like this. Please leave questions in the comments. And if you like this video, share with a friend, like and subscribe again. Thank you so much.